we're going to go through our steps of how we build a loan. And we're going to, it's a very simple model, which why I think people like using us. And so we're going to go through how we build a loan. And this particular example that I'm going to go show you guys, actually this loan is closing today. Matter of fact, it might be even closing right now as we speak. And so the first part of the loan, I call it the loan handshake. And the first part of the loan handshake is basically what we call the client package, right? So the client starts off, well, they'll either call me, text me, or email me, but honestly, guys, please email me. It's much easier, because if I have to jump from email to text to phone call to email to text, it's much easier if I have everything in front of me. And so what this is this actually is an introductory email from a client that wanted a loan. And this email came in, I don't even remember when. I think it might have been 10 days ago. Actually, it says we're scheduled to close next Wednesday, 6/24. So this must have come in Monday or Tuesday of last week. It's normal for us to close a deal in 7 or 8 days or less. I'm not talking business days, I'm talking physical days. And so this is sort of normal for us. And so in this particular client package, he supplied me with a lot of good stuff. Number one, he supplied me with obviously the address and where it's located. He described the property, which in this case, this is a 3-bedroom, 2.5-bath, semi-detached house in Washington, D.C. It's in a development called Riggs Park, if you guys are familiar with that. He actually gave me the renovation budget. He went pretty detailed into his renovation budget. And he also gave me an after repair value with some included comps and a requested loan amount. Now, from an email package, this is absolutely perfect. This is exactly what we need. And so what I could do is I could build a loan from this. Now, what you're not seeing is a bunch of riffraff. What you're seeing is that we are going to build a loan based on the asset, because we are an asset-based lender. I ask about credit sometimes. I don't think we've ever really checked credit once. We don't even have people fill out an application. It's as simple as, if I like the asset, if I like the ARV, if I like the renovation budget, and I think it could be done in budget, on time, get the house on the market, then odds are we're probably going to do it. So this is what the client provides. And so we live by the words trust and verify. So what I'm going to tell you is that I trust what he says, but the next thing that we need to do is we need to verify what he says. So what I want you guys to keep an eye on is I want you to keep an eye on this thing called the after repair value, where he says 625 to 635, and that will take me to the next slide.
Okay. Hey, Charlie, one question, since you talked about credit scores. Are you guys looking at new minimum credit scores criteria for your fix and flip currently?
Not really. I mean, I'm looking at the asset, and I'm looking at the price of the renovation. And so if the renovation is very steep, then all we're doing is we're adjusting our lending parameters. And so, however, we do have a broker business called Clear Sky Nation, where I could take you out. I mean, one of the things about us is our rates. We have rates and points with our loans. And so if you want, a little bit more competitive rate, I could broker that out, but you're going to have to come up with a lot more capital, and your credit scores have got to be 650 and above. And so where our forte basically is just straight asset-based lending. You've got to be able to execute. We are more concerned with your contractor than your credit score, because your contractor is what protects us. Your credit score does not. Now, if you don't pay on your loans, we'll help you with that. But your contractor is a lot more important to us, and we need your project done correctly and on time and in budget, because that's where our risk is. Our risk isn't really necessarily with maybe a bad borrower with a bad credit score, because remember, a lot of these guys are trying to get back on their feet. We understand that, and so we're willing to take a chance on a bad credit score person, because remember, a bad credit score person eventually could become a good credit score person if they can do a couple of flips, or even one flip, profit 30 grand, pay off some of their debt, and their credit score will jump from 550 to 630 because they paid off all their debt. So, or 680, and they become a good credit score person. So that's our business model. It's not perfect, but for us it works, because we came through the fix and flip business. And so we know the assets, we know the renovations, and we know the contractors, and we know all the government guidelines. We know how to pull permits. We know what you're supposed to do. So we're really good at that. So we can take a chance on a lower credit person. All right, next slide.
Ready?
Okay, so remember, the other thing that came with this email is he sent pictures. You don't see that. You see a link to the comps on the email, but you don't see the actual attachments. So like I said, this was probably close to a perfect initial package that I want to see. And so what do I glean from the pictures, right? And so in this case, his renovation is $60,000. He goes through a bunch of stuff on what the renovation is. And so I could quickly take a look at these pictures on the next two slides, and I can verify that his budget is close enough to 60 grand. So I just do a macro level cursory check. I say, hey, look, these pictures look pretty good. And the most important thing that you see from these pictures is what's the most important thing that you guys see? If you answered vacant, you are 100% correct. Condition, I care about, but more important than that, we care about vacant properties. Now, when we're buying properties into this market on our fix and flip business, and when we're lending into these properties, they have to be vacant. I repeat, they have to be vacant. And if they are not vacant, you need to either have an exit date with that person if they're selling it, which you should have anyway, or you must have a keys for cash agreement. If you do not have those things, we will not buy it and we will not do the deal right now. Courthouses are closed as far as evictions are concerned. They're starting to open back up in Northern Virginia. DC and Maryland, if you got an occupant in there, experience says it takes a very long time to get them out. So we're not going to risk any hard money, and we're not going to risk a purchase with an occupant in there. So believe it or not, the most important thing about these pictures is the fact that this property is vacant. Okay, next slide. Okay, so the next thing that we look at are comps. So I've already verified a bunch of things. I verified that the $60,000 budget is close enough. I mean, hey, we're within 10%. We're good, 15%. That's close enough for me. So the next thing, and we verified that it was vacant. Check, check, right? So now I'm trusting the borrower. This particular borrower was not a repeat borrower. This is a first-time borrower. However, this borrower came from a very good referral source, but I'm still verifying. So the next thing that I want to do is I want to verify the comps that he sent. Okay, so these are basically the comps that he sent. All right, you'll see these things that kind of match his number. His ARV is between 625 and 635. So you see a bunch of comps, 629, 618, 615. We could go into more detail if we have to, but we don't really need to for this exercise. So I'm close to verifying his ARV number. Now, one of the things that you need to look at is the actual square footage, 1156, 1080, 1156. So what that tells us is that we know that this is a 3-level property because he told us that it was 3 bedrooms, 2.5 baths. And so we sort of know the basics of the property. Like I said, it's also a 3-level property. Now, in DC and the semi-detached, even though it's not in these comps, like a 1080 means that it's going to have a 1080 on the top 2 levels, and then it's going to have a 540 in the basement. So that gives me a good idea of the square footage. So it's very important in DC that you need to know your square footage because usable, livable square footage is where it's at, okay? So keep an eye on that square footage on these comps. And so then I'll take you into the next slide of what we do to verify this. Because not only you as the borrower, you're going to tell me what your ARV is, but the most important thing is I'm going to verify the ARV because that's a very critical piece into how we build a loan. Okay, so then the next set of slides is part of our due diligence on a loan, and we're calling it the Clear Sky Financial Due Diligence. That's good, Sandra. Next slide. And so the first thing that we look at on each asset is the actual tax record. And so in this particular case, on 209 Oglethorpe Street, this is the basic tax record. So what I'm looking at are a bunch of things here. The most important thing is obviously the subdivision. DC is a little bit more challenging than the suburbs because the suburbs are very subdivision specific. DC is sort of subdivision specific, but you've got to kind of do a boundary of the streets because you might go across lines, so it's not that easy. So in this particular case, this property is located in Riggs Park. If you go to the bottom of this slide, you'll see something just as important. The property type is a semi-detached property. A semi-detached property is not a row home. It's not a single family house. It's basically in what we call in Virginia, a duplex. And so Maryland, I think they call it duplexes too, maybe semi-detached. In DC, they call it a semi-detached. So basically it's two properties side by side. So that's very important too. I got to understand the property type. Now, the third thing that we have to understand is this thing called taxable total assessment. I need to understand what the taxable assessment is on this property. So when I go to compare it to other properties, that's another one of my indicators. And so we create something called the tax assessment multiplier. We call it the TAM. So I kind of get a good idea of our property selling for 5% over tax assessment, or it's selling for 10% over tax assessment. And in this case, it's selling for about 50% over tax assessment. So if you just simply add 360 plus 180, you're going to get close to maybe what he thought his ARV is. So in this case, they're selling between 40 to 45% of tax assessment. Now, the next thing that we look at, which is the most important thing, that is the square footage. Now, remember, the square footage of this property is 900 over 450. Now, why is this important? Because the comps that he used had square footages of 1080 and 1150. So this square footage is 90% of what he used as comps. And so I'm very concerned there, right? Because the DC game is all about the square footage. I mean, any renovator, any developer, you know, they will tell you the name of the game in Washington, DC is square footage. So right now, I'm trusting, I'm sort of verifying, but I do have not a red flag, but I've got a yellow flag going up because the comps provided were not really in line with this asset type from a square footage standpoint, but that's okay, no big deal. So then what we do on the next slide is I then go and I pull my own comps. So let's look at something pretty critical here, and that there's a couple of things going on here. Now, the comps aren't exactly perfect in Riggs Park because the asset type that the borrower's bringing us isn't really included in the comps. There are no 900 over 450s available in Riggs Park or under contract or recently renovated. So I couldn't go there with the exact likeness. So what I did is I pulled comps that were close. Maybe one or two might have been similar to what he pulled. Okay, no problem. But the key one that I focused on is the active. What's going on in the active market? Well, we have a very beautiful renovated property at 620, 1,088 square feet. I've got one closed, 1,156 square feet at 615. Okay, now remember, our subject is about 90% of this. So then what I did is I said, okay, you think you have an after repair value of 625? I said, no, in this asset price, I just simply reduced it by about 7 to 8%. And I came up with a very nice conservative after repair value of 575. And so that's the after repair value that we're using on our loan, 575. And so usually what I do then next is, Sandra, go to the next slide, is not only do I share my findings with the borrower so that we're comparing apples to apples, orange to orange, we're comparing this. I'm saying, okay, in this case, Doug, I'm saying, Doug, I agree with your renovation price. I think your ARV is a little out of whack, a little bit, not much, but you know, remember though, if you're right, that money's gonna go into your pocket. We need to be right because we're building a loan based upon those two factors. So what I do to build a loan basically is I've got a simple loan spreadsheet, and I will tell you exactly what we're doing. Look at number one, purchase price, straight from the email. He's buying it at 360. Remember, I haven't gotten a renovation budget yet. I haven't gotten a draw schedule yet, and I haven't really gotten a ratified contract. We're just building the loan. This is not a live deal yet. So first thing I do, I pop in the purchase price at 360. I'm okay with the $60,000 renovation, but I'm popping in my ARV. At this point in time, we're the gatekeeper. So we have to agree on the ARV. In this particular case, he was fine with it, no big deal. But it really didn't impact the loan that much because we were only off maybe, you know, 50 grand, 60 grand. So it wasn't that big of a deal as we're building the loan. And remember, he requested a loan amount of 420. That's key as well. And I keep that in mind because that's important because I need to understand that. So then what I do, if you go to section 2, and you look at this thing called the LTV of the ARV. That is the loan to value of the after repair value. And so in this case, it wasn't that much of a renovation. 60,000 isn't a big deal for us in DC. If it gets to be about 150 or more, I'm gonna jack that number down from 70% to between 60 and 65%. I'm gonna lower it. But in this case, I felt comfortable loaning on 70% of the ARV, right? So I get a number at 402,500. Okay, so that's one of my parameters. Pretty decent. I'm okay with that. So I'll give him a $400,000 loan. The second parameter that I look at is the LTC parameter. What that stands for is loan to cost. Basically, what the loan to cost is, it's basically the 360 purchase price plus the $60,000 renovation price. And so we get a number of $420,000. And so what I want to do, normally I'll look at, maybe a 90% LTC. I'm comfortable with that. But I was comfortable with the sophistication of this borrower, that I felt like he knew what he was doing. And so I liked his renovation budget. I liked a lot of things about this borrower. And oh, by the way, he had a pretty high credit score. At least that's what he told me. It was in the low sevens. And so I was okay with that. So in this particular case, even though our new parameters post-COVID is probably LTC 85 to 90%, I felt comfortable. I felt comfortable going to 95%. So that gave me a number of about 399. So now I'm within my 70% LTV of the ARV. It's got a small renovation. This guy's going to be able to knock that renovation down. So if you look on section 3, the proposed loan back to this borrower is $400,000. So then what I do is I package up this spreadsheet, put it into a PDF. I send it back to the borrower saying, look, we could do a loan for your project at $400,000, but the loan is going to look like 340,000 of it is going to go to your purchase, and $60,000 of it is going to go to your renovation. So we're doing 100% renovation on this case, and 340 towards this purchase of 360. Now the $60,000 renovation is going to be broken down into 3 draws of 20,000. So now if you go down to section 4, it then defines to the borrower how much cash he's going to have into the deal. So he's going to have a $20,000 down payment towards his purchase, and the closing costs are going to be, approximately $20,000. So his expectation is he's going to have $40,000 into this deal. And so I send that back to him. And then what happens is he comes back and says, hey, that's fine, because remember, this guy wanted a requested loan amount of 420. I'm not really meeting the mail there, but I am meeting the mail with a $400,000 loan. He came back and said, yeah, that's fine. I then request ratify contract, renovation budget, draw schedule. He sends it back. I actually get a point of contact from the title company. I send him back a 1-page term sheet. Bang, boom, bam. The loan is done. Less than a week, and it's closing today. And so that's how basically we build a loan. It's very simple. It's very straightforward. And the term sheet is 1 page. And this thing is getting closed in seven actual days, maybe 8 actual days or less. And that is a typical deal for us. Any
Great, thanks,
question
Charlie.
on
There is a question out here. If you guys have questions, definitely send them in the question box. Are all of your loans non-recourse, or do you have any loans that are non-recourse?
100% of loans are non-recourse. We don't have time to chase bad borrowers. Honestly, just hand us the asset. We don't have time for it. Especially in Washington, D.C. None of our loans are personally guaranteed. And the reason behind that is it's all about the foreclosure process. We don't want you to have consumer rights. We don't want you to have arbitration, and we don't want you to have the ability to hold us up. We don't want it to be a judicial process in DC. We want it to be a non-judicial process. We want to be able to either foreclose, do a deed in lieu of foreclosure, get our property back so we can get in that asset, renovate it, and put it on the market. Now, this doesn't happen very often with the majority of our borrowers, and I mean 97.5%, 98% of our borrowers are all good. They do good work. The percentage of the borrowers that don't, remember though, we have a good communication line going with our borrowers, even if they're failing on a project. So 9 times out of 10, they're just going to come to us with troubles. But we're going to know about troubles at the very beginning of the project. So like, for example, if we're giving this guy out a $20,000 draw, his first draw, and if he doesn't meet his draw one milestones, then we're gonna be in trouble. We might take the project back right then and there, because if he's not meeting the mail, then we need to know right up front. So we know within a month, and so it's very important for these guys to be on time and on schedule. And so what we do that nobody else does is we do a pre-draw. So remember, in this particular case, we're going to send this guy our borrower first $20,000 draw. As a matter of fact, he's closing today. We're probably going to send it to him tomorrow, but he's already sent me a draw one milestone. And so it's very, very important for him to get draw two that he meets draw one. And so we don't have any, all of our loans are non-recourse. We don't want any troubles. We want these things to be successful. If they're not, give us back the house. We'll take care of it.
Okay. For this particular deal, what is the general carrying cost? And then what was the time to flip, or what is the time to flip?
All right. So since it's Washington, D.C., because things are a little bit more complicated in D.C., sometimes you got to deal with DCRA. You've got to get your permits, got to get it approved. You got to have your architectural diagrams. We give a 9-month term in DC, and we give a 3-month extension added in. We might change those parameters a little bit, but basically in DC, we do a 9-month, 3-month. In Northern Virginia, where the market's hot, we're probably going to do a 6-month, 3-month. And that's basically the way it is. And then our points and terms, I could send brochures out to you guys if you don't already have them, but we're interest only. We have no prepayment penalty. So if we give you a 9-month loan and you're out of it in 4 months, then you're not paying 5 months of that term. There's no prepayment penalty. So for us, though, the name of the game is execution. It's getting the property renovated, and it's getting it on the market, and it's getting it sold. And so that's the name of the game. And so for us, there's a monthly interest-only payment. If some of the assets are so high in ARV compared to the loan amount, I might build in, 3 or 6 months of payments into the loan, and so you don't have to really make payments. And so that's basically the way we do it.
All right, questions are coming in now. What is your cost for a draw request?
Usually it's running at $250. So if we have repeat borrowers and we know the quality of their work, and if they're using one of our preferred contractors, then we won't charge a draw fee, just because we know the quality of the contractor and we know the quality of the borrower. But at the onset, it's running $250 a draw, because either myself, Sam, not me, has to show up and make sure that these guys are meeting the mail as far as the contractors. And if they're not meeting the mail, then like I said, we put a halt to it until that contractor gets on track.
Since you're speaking about it, can you talk about the draw schedule too, one of you guys, as you're talking?
Yeah, we have a template draw schedule, and if anyone wants to see it, they can send us a quick note or an email. And it just breaks out the project by at a pretty granular level. Okay, I'm going to renovate all the plumbing at this point, the electrical at this point, do the paint at this point, the roof, and so forth. And so we're looking for those milestones to be met at the end of the draw period. So we'll give a pre-draw. It's very distinctive from some of our competitors who give you the money after you've done the work. So we'll give you the money in advance of doing the work, but before we give you the next draw, we do need to see that all of that work is completed. So in the first draw, generally I'll be present on site, and then I'll understand the entire project and its scope. And on the second draw, then a complete video of it will generally suffice, unless the project has a lot of subtlety that needs to be gone over. But a video of everything that's been done and a walk around of the entire property is sufficient for the second draw review. So we can do draws on the same day as the request after the first site visit.
Okay. Let's see. Are all your deals requiring a down payment?
Yes.
Yeah. Post COVID. Yeah. Because and I talked about this earlier. Pre-COVID, I could go to 95 to 100% loan to cost when we had a good idea of where the market was heading. Post-COVID, 6 to 9 months from now, honestly, we kind of have a crystal ball, but we're not sure. We think we're at the peak of the market. And so we're pricing in to the peak of the market. And so we're having these borrowers have a little bit more skin in the game, way less than our competitors. I still think from a 90% LTC, I think we're probably the top. And so the days of the 100% on LTCs, they're gone for a minute. I don't even think any of our competitors ever offered it. We were one of the only ones in the area that even offered it. And so we're down to about 85 to 90% LTC. So we want to see more skin in the game from the borrower, because if this market turns, you might have to turn your property into a rental, and you're going to have to refinance us out. So at least at that point, if you have 10% skin in the game, you're already buying it at a 30% equity position, you have to turn into a rental. Well, you're going to have to refinance us out as a rental, because you don't want to keep us hanging out there more than 9 months. Trust me, our cost of funds too is a little too high, and it's too expensive from a rental standpoint. So you got to have the ability to refinance us out in case this market turns. And so the days of 100% for us, unless I love the asset, I had a deal where the guy wanted 250 on an asset free and clear, and the asset fixed up was worth 750. All right, I sent the 250 out. I priced in 6 months worth of payments. Okay, we're totally, in the clear as far as that asset's concerned. Even if the market tanks 30%, we're in the clear. So it's case by case, but those 100% deals are, they've gone the way, they're kind of gone at this point. I don't know if they're ever going to come back. It's a
Okay,
good
great.
question.
In Virginia, are they non-recourse and same LTV? What is your minimum loan size?
In Virginia, you do sign a personal guarantee. We've never once pursued a personal guarantee, but it does keep an additional checkpoint for us, so we can motivate people to give us a deed in lieu of foreclosure, so they don't just let it lay fallow and wait for whatever happens in the foreclosure marketplace. Our goal is, if a person's not having success with their project, that they just turn it back over to us and we move forward. And the other aspects of the question, I'm sorry, Sandra, were what's the LTV in Virginia?
Yes.
Or the LTC? Yeah, we're
LTC.
keeping it about the same as Charlie described what we're doing in the district.
All right. We have about 5 minutes left, and a few more questions. Have rates gone up due to COVID?
No, as a matter of fact, for us, we've kept everything the same. I mean, we haven't changed. I mean, maybe a half a point here or there, but we've kept everything the same. We've never changed. And the reason why we didn't change is because pre-COVID, I mean, we're going to be a little bit higher than a lot of the old guys back in the day. The Washington Capital Partners of the world, the Walnuts of the world. We're going to be a lot higher because we never had a broker model. We've never sold our loans. We've always kept our loans. And so we understand what it takes to take a property back and renovate it, and the time it takes to finally get our money back. So by us keeping our rates high, that sort of kept us in the game, and we've never left the game. And so we've been in this business for almost 7 years, and the COVID startled us a little bit, but it certainly didn't take us out of the game. And because we were able to keep our rates a little bit higher, this is what kept us in the game. And so I don't anticipate a change either way. We're going to stay the same, because at the end of the day, whether you're talking a 12 or 13% interest only payment versus an 8, 9, or 10, if you're executing your project and you're round tripping in 120 to 150 days, it doesn't matter, because it's all interest only. And so if you do the difference between a 13 or a 12 compared to a 9 interest only, and you're out in 120 days, come on, that's negligible. But the other difference is that you're going to be paying less in capital than you are with a competitor where you might be able to get 9%. You might be putting up, 70, 75% LTC. With us, you're putting up much lower. So it just depends. Do you want a higher rate of return on your money, the ROI on your cash? I would, or do you want to get that rate and put up more capital? Just depends. But we didn't raise our rates, and we're certainly not going to lower them just because of the space we're in. We're in an asset-based lending space. There are risks associated with it. There are borrower risks who have bad credit that might slip through the cracks. But hey, that's the nature of our business. We get it. And so we're in it for the long haul.